Right now, Bitcoin is sitting at roughly $63,000. It's down almost 50% from its all-time high of 126,000. The fear and greed index just hit 5 out of 100. 5. And a prominent economist just went on camera and declared that Bitcoin's fundamental value is zero, and that this could be, and I quote, the beginning of the end. But here's what he didn't tell you, and what I found in the on-chain data is going to completely change how you see this crash. If you're serious about protecting and growing your Bitcoin position in the most volatile market we've seen since 2022, subscribe right now. I break down the real institutional and whale data every single day, not just opinions, not just theories, the actual numbers that move this market. So here's the situation. A few days ago, Professor Steve Keen, a well-known economist, gave an interview where he laid out his case for why Bitcoin is finished. He compared it to tulip mania. He called it a Ponzi scheme. He said the energy costs would eventually force governments to shut it down. And he pointed to this crash from 125,000 down to 65,000 as evidence that his thesis is finally playing out. Now look, I respect the man's credentials. He's been studying financial systems for decades. But here's the problem. His entire argument is built on theory, not a single piece of on-chain data, not one reference to what institutional wallets are actually doing right now, not one mention of ETF flow mechanics, not one word about supply dynamics post-halving. And when you actually pull up the data, what you find doesn't just challenge his thesis, it demolishes it, and I'm going to show you exactly why, point by point. But first, let me set the stage because the fear right now is real. Bitcoin has crashed roughly 50% from its October 2025 high. We've seen $3.8 billion flow out of spot Bitcoin ETFs over the last 5 weeks. That is the longest outflow streak since February 2025. BlackRock's IBIT alone shed over $2.1 billion. Fidelity's FBTC lost $954 million. The crypto fear and greed index has been below 25 for 22 consecutive days. That has only happened 3 times since the index was created in 2018, August 2019, June 2022, during the FTX meltdown, and right now, $468 million in leveraged positions were liquidated in the last 24 hours alone. A single trader on HTX lost $61.5 million in one liquidation. Bitcoin is now testing its 200-week moving average around $60,000. So yes, the fear is justified, the pain is real, people are hurting. I'm not going to sugarcoat that, but here's where Professor Keen's analysis falls apart. And this is the part that nobody talking about this crash wants you to focus on. While retail investors panic sell, while ETFs bleed, while the media runs headlines about Bitcoin going to zero, the largest wallets on the Bitcoin network are doing the exact opposite. They are buying aggressively. CryptoQuant data shows that on February 6, 66,940 Bitcoin were transferred into accumulation wallets in a single day. One day, at current prices, that's roughly $4.4 billion. Glassnode confirmed that wallets holding more than 1,000 Bitcoin added over $4 billion in exposure in the week that followed. Sentiment data shows that addresses holding between 10,000 and 100,000 Bitcoin accumulated over 70,000 Bitcoin in early February alone. That's $4.6 billion in fresh exposure from the largest, most sophisticated players in this market. Now ask yourself something. If Bitcoin's fundamental value is truly zero, if this is tulip mania, if this is a Ponzi scheme collapsing in real time, why are the biggest wallets on the planet loading up billions of dollars worth of Bitcoin at these exact prices? If you're running a Ponzi scheme, you don't buy more of the thing that's supposedly worthless. You sell, you exit, you run. That's what Ponzi operators do. But that's not what's happening here. Whales are accumulating at a pace we haven't seen since the bottom in 22. And the last time they did this, Bitcoin went from 16,000 to 126,000 within 2 years. Comment below, are you accumulating at these prices? Or are you waiting for lower? I want to know where your head is at right now. Let me break down the professor's specific claims because I think it's important we address them with actual data instead of just theories. His first argument was that Bitcoin is a Ponzi scheme, that its only value comes from new buyers paying higher prices. Now, on the surface, this sounds clever, but here's the fundamental flaw. A Ponzi scheme requires a central operator who takes new investor money and pays it to old investors while skimming off the top. There is no central operator in Bitcoin. There is no company. There is no CEO. There is no one collecting fees and redistributing them. Bitcoin is an open source, decentralized network with a fixed monetary policy. You can verify every single transaction on the blockchain. You can audit the total supply. You can confirm that only 21 million will ever exist. That is the opposite of a Ponzi scheme. A Ponzi scheme relies on secrecy and deception. Bitcoin is the most transparent financial network ever created. His second argument was the tulip comparison. Now, this is the laziest critique in financial history, and it's been wrong for 15 years. Tulips had no network, no utility, no fixed supply, no global adoption curve, no institutional infrastructure. Bitcoin has been declared dead over 470 times, according to 99bitcoins.com. Every single time it recovered and made a new all-time high, tulips collapsed once and never came back. Bitcoin has survived the Mt. Gox hack, the China ban, the 2018 bear market, the COVID crash, the FTX collapse, and now this crash. And every single time, the people who bought during the fear made generational returns. That's not how tulips work. That's how a disruptive technology works during its adoption curve. If this is opening your eyes to what's really happening beneath the surface, hit that like button. Let's see how many of us actually look at the data instead of just listening to headlines. Now, here's his third claim, and honestly, this is where it gets interesting. He said Bitcoin's price movements are driven entirely by the fiat money supply, that when governments spend more than they tax, people have extra cash and they buy Bitcoin. And when governments pull back, Bitcoin falls. Now there's actually a kernel of truth here. Liquidity matters. Bitcoin is sensitive to global liquidity conditions. We saw this clearly during COVID, when stimulus checks absolutely did boost Bitcoin demand. But the professor makes a fatal error. He treats this as proof that Bitcoin has no independent value, that it's just a mirror of fiat dynamics. But by that logic, every asset on Earth has no independent value. Stocks rise when liquidity expands. Gold rises when liquidity expands. Real estate rises when liquidity expands. The fact that Bitcoin responds to liquidity doesn't mean it's worthless. It means it behaves like every other financial asset. The difference is Bitcoin has a fixed supply cap of 21 million. Stocks can be diluted, dollars can be printed, gold can be mined, Bitcoin cannot be inflated, and that scarcity premium is exactly why institutions are allocating to it. Now let's talk about the ETF situation, because this is where the professor's argument about financialization being a mistake gets really interesting when you look below the surface. Yes, $4.5 billion has flowed out of spot Bitcoin ETFs in 2026 so far. That's a fact. But here's what most people aren't seeing. Those outflows aren't random panic. A significant portion of the ETF selling is the unwinding of basis trades by hedge funds. These are arbitrage positions where funds buy spot ETFs and short futures to capture the premium. When the premium compresses, they close both sides. That shows up as an ETF outflow, but it's not someone deciding Bitcoin is going to zero. It's a mechanical trade closing. Bloomberg's Eric Balchunas pointed this out explicitly. He said the larger picture remains historically bullish for the asset class. The structural footprint of Bitcoin ETFs is largely intact. And here's the other thing the professor missed entirely. While ETFs bled, hedge funds have turned net long on Bitcoin. That was reported just this week. So the narrative that institutions are abandoning Bitcoin is not what the data shows. What the data shows is institutions rotating their positioning, trimming short-term tactical trades while the macro environment is uncertain. That's what sophisticated capital does. It doesn't mean they've given up on the asset. It means they're repositioning. Do you think Bitcoin hits $100,000 again before the end of 2026? Comment yes or no below. I'm reading every single one. Now let me address the energy argument, because this is the one that gets the most emotional reaction. The professor said that at some point, governments will realize the biosphere is being destroyed, and they'll shut down Bitcoin mining as one of the first energy cuts. Now, I'm not going to debate climate science here, but I am going to point out some data he completely ignored. Bitcoin mining has become one of the most renewable energy-intensive industries on the planet. According to the Bitcoin Mining Council, over 60% of Bitcoin mining now runs on sustainable energy sources. Miners are actively seeking out stranded energy, flared natural gas, and excess renewable capacity because it's the cheapest energy available. Many mining operations are now acting as flexible load resources for electrical grids, actually stabilizing energy systems rather than straining them. The idea that governments will simply shut down a trillion-dollar global network because of energy concerns ignores the economic and geopolitical reality. Countries that embrace Bitcoin mining gain a competitive advantage. Countries that ban it lose capital and innovation to those that don't. El Salvador didn't shut it down, they're still buying. The United States has a strategic Bitcoin reserve initiative. Multiple states are passing Bitcoin-friendly legislation. The trend is toward adoption, not prohibition. And here's a data point the professor should really sit with. Bitcoin's mining hash rate just reached all-time highs above 1.15 zettahashes per second. Mining difficulty is at record levels. If Bitcoin were dying, if its fundamental value were truly zero, miners would not be investing billions of dollars in new equipment and infrastructure to secure the network. They would be shutting down. Instead, they're expanding. That tells you everything you need to know about what the people with the most skin in the game actually believe. Now let me bring this all together with the on-chain data that I think matters most right now, because this is the part the professor never touched, and it's the part that could literally change your financial future. Bitcoin's 200-week moving average is currently around $60,000. We are right on top of it. This level has been tested exactly 4 times in Bitcoin's history. Every single time it held, every single time it marked the bottom of a bear market. And every single time, Bitcoin went on to make a new all-time high within 12 to 18 months. The MVRV ratio, which compares market value to realized value, is now in the zone that has historically marked cycle bottoms. The SOPR, or spent output profit ratio, is below 1, meaning Bitcoin holders are selling at a loss. This is the definition of capitulation. And historically, when short-term holder SOPR falls below 1, while whales accumulate, it has preceded every major Bitcoin rally in the last decade. Glassnode's net realized profit loss data shows roughly $500 million per day in realized losses from short-term holders. That's seller exhaustion. That's the weak hands getting flushed. And on the other side, long-term holders and mega whales are absorbing that supply. The number of entities holding at least 1,000 Bitcoin has risen from 1,207 in October to 1,303 today. That's nearly 100 new whale entities entering the market during the worst crash since 2022. Share this video with one other Bitcoin holder who needs to see this data before they make a decision they'll regret. Let me be crystal clear about what I think is happening. This is not the beginning of the end. This is the final shakeout. This is smart money, separating you from your Bitcoin at the cheapest prices they'll ever get. The professor looks at Bitcoin and sees a speculation bubble. The whales look at Bitcoin and see a generational accumulation opportunity. And the data, not theory, not opinion, the actual verifiable on-chain data tells us which side is putting their money where their mouth is. 400 times Bitcoin has been declared dead. 400 times it came back stronger. Every bear market in Bitcoin's history has felt like the end. 2014 felt like the end. 2018 felt like the end. 2022 absolutely felt like the end. $16,000, FTX collapsed. Celsius collapsed. Luna collapsed. The entire world said crypto is finished. And what happened? Bitcoin hit $126,000. The people who bought at $16,000 made almost 8x on their money. The people who sold because some economist told them it was going to zero missed the greatest asset rally of the decade. Now, I'm not telling you what to do with your money. This is not financial advice. I'm sharing what the data is telling me and what I'm personally watching. But I will say this. When the fear and greed index is at 5, when whales are accumulating billions, when short-term holders are capitulating, when the 200-week moving average is being tested and holding, when mining hash rate is at all-time highs, when the MVRV ratio is in the buy zone, the historical pattern is overwhelmingly clear. This is where generational wealth is built, not at the top when everyone is euphoric, at the bottom when everyone is terrified. We've been through this before. We held through 2018. We held through COVID. We held through FTX. We held through Luna. And we're holding now. That's what separates the people who build wealth from the people who talk about it on podcasts. Tell me in the comments, how much Bitcoin do you own? Are you still accumulating at these prices, or are you done? Drop HO deal if you're not selling before this cycle plays out. I want to see who's still standing. If you haven't subscribed yet, do it now. I put out daily Bitcoin analysis with real data, real on-chain metrics, not just theories from academics who've never owned a single Satoshi. Like this video. If you're still bullish on Bitcoin, let's see how many of us are still here. And join my Bitcoin inner circle for member-only price targets and on-chain analysis that I don't share anywhere else. The professor says this is the end. The whales say this is the beginning. The data says the whales are right. I'll see you tomorrow.